Well, welcome back to another episode of the Financially Free Journey podcast. And I'm your host, Courtney Dyer. And as you guys know, this podcast aims to dispel the seemingly complex topic of finances, right? Money management, debt, savings, investing, and even retirement. And today, I am bringing on Mark Willis. He's a fellow host, a fellow podcaster of the Not Your Average Financial podcast. And Mark has tons of industry experience. He's a certified financial planner. He's a 3-time #1 best-selling author, and he is the owner of the Lake Growth Financial Services. So he is absolutely an authority and an expert in this space. And we're going to be talking about a lot of good stuff today, guys. So Mark, how are you?
So good, Courtney. And I loved our chat beforehand. I think you're living the dream, as you said. I'm just trying to keep up with you.
It's my favorite phrase. It's so funny because people always say, living the dream. I'm like, look, I really am living my dream, but it's also my default because it's like when people are like, what'd you do over the weekend? I'm like, I don't know what I do. 10 loads of laundry, so it's one of those answers, but I digress. Mark, tell me a little bit more about your background, because you have this highly successful business where you help people with their financial freedom and achieving their goals and building wealth. So tell the listeners a little bit about your background and how it brought you to this point.
Sure. I'm going to go further back than you might expect, Courtney, for fun. Hopefully this is a fun
origin. Story. Let's do it.
Yeah. Right next to the Ninja Turtles. I'm not quite as cool as their origin story, but let's get fun here. So as a young kid, I was probably 5 years old. I had been saving up 5-6 years old. I'd been saving up some cash allowance, whatever, in a little paper bag in my top drawer of my chest of drawers. And I was pretty proud of this. I think I had collected almost $50 or something.
Dang.
And yeah, not too bad, right? And this little paper bag. And my mom, being a good, wonderful parent, wanting to teach me about the ways of banking, she says, all right, son, it's time to take your money and take it to the local bank. And so I did. I clutched my paper bag. I walked with her to the car. We went to the bank. We walked into the bank, sat down, and this person, I still kind of remember the guy's face, I think. I had to hand him all of my life savings and watch him walk away with it and hand me a little piece of paper in response as a receipt.
You're like, ouch.
Yeah, that's right. I was so skeptical that this guy was going to handle my money as well as I could have in my little paper bag. And I know it sounds a little odd to say, but I was probably a little spot on with my skepticism, because now that I've learned about strategies like fractional reserve banking that banks now take, to the T, I had more safety and security in that paper bag than the bank had in terms of keeping my cash on hand. I was surprised to find out that banks don't keep all of our deposits. When I give them a bank deposit, it's not like they just put it, in the vault with a shoebox, in a shoebox with my name on it. No, they're lending that money out. And that was a surprise to me as a young adult. So anyway, that's my origin story. But taking it forward a little bit further, I found myself a few years later signing away my freedom to a number of student loan companies. And my wife and I, we ended up graduating with 3 private school degrees between us and $120,000 in student loan debt in the midst of 2008. In today's dollars, that'd be close to $250,000 with inflation. We had no jobs, no plan to pay off the debt, no real awareness. We didn't take your course, Courtney. We didn't know to pay attention to our money. So it was a light bulb moment when I realized that the student loan bill was not going away. And I had to come up with a strategy and a means by which to break free, because it was seriously a form of slavery. And that's sort of where our money journey began.
It's so spot on when you said it's a form of slavery, because I was actually just listening to someone that was a keynote speaker at a conference I attended. And she mentioned that, when she had this epiphany, when she realized that her debt absolutely controlled her and she was a slave to her debt, because it controlled when she could have children. It depended where she could live, what kind of job she could accept, because the debt now controlled her not being able to necessarily accept a job that she had passion for and she would be excited to do. She had to accept the job that paid more because she had to pay her debt. And it's just, when you said that it's like you're a slave to it, it's so true. And I think a lot of us have this epiphany when we're maybe later 20s and 30s, right? Where it's like, it all starts clicking. It's like, what did I just freaking do for the last, the first half of my 20s? What was I thinking? And then it takes a while to dig out of. And it can be also intimidating. So what did you find that helped you with you and your wife from that state that you guys were in, right? You graduated with tons of student loan debt. You had that weight on your shoulders. What did you guys do, to get out of that?
Well, a lot of people come to me with this same question. Hey, Mark, I'm in debt up to my neck. And also I see time slipping by and I'm not getting any younger. And, the kids need to go to college themselves, or our own retirement is coming up here. And Mark, should I pay off all this debt, or should I save and invest? And that's the conundrum that a lot of folks come to me with on Zoom or over the phone when we have financial consultations with clients all across the country. The issue is really just, we don't know if we should be putting away on this bucket for our future or paying off the old bucket from our past. And there's really like no in between. It's really difficult to make a decision when you're faced with, obviously it's easier to pay off a debt because those creditors, they're sending you bills, they're calling you at dinner time, they're wrecking your credit score. Your savings, your future self, well, he's not, or she's not really shouting at you as much. In fact, there's this great Simpsons quote. Homer's like drinking some vodka and mayonnaise or something terrible. And Marge is saying, aren't you concerned about future Homer? And Homer says, oh, future Homer sucks to be that guy.
I love it. It's good when it's a quote from The Simpsons and specifically from Homer Simpson. Okay.
That's right.
Yeah, it does suck to be that guy, right? If you're not putting the future you at the forefront of the decisions you're making, you're going to pay for it.
Right. Yes. And so true. Like most Americans, this is a stat from the U.S. Commerce Bureau, 37.5% of our income, 37% of our income goes to service our debt. Oh. Let that sink in for a minute.
That feels gross.
Yeah.
That feels gross to say. Okay.
Well, if time is money, what is a third of your day?
Yeah.
We're working
paying
for
off
a bank.
Debt.
Exactly.
Yes.
Exactly.
We're all employees of a bank, but we just don't realize it.
That's right. We're employees, but we're the ones paying the bank. They're not paying us.
Yeah.
So it's why banks are the biggest buildings in town. It's why banks have had the best run of business for human history. There's a great book out there, Courtney. It's called Debt: The First 5,000 Years. That's quite a title right there.
Wow. It's called Debt: The First 5,000 Years. I was like waiting for it to drop. I'm like, that's the title.
Yeah. And so point is, like, there are strategies, and my wife and I, thankfully, a mentor of ours came by and sat down with us. He was a former college professor of ours. He knew our focus, our just dead heat toward getting out of debt. He knew that we were chasing debt down using something called the debt snowball method. Yep. And he knew that there were some value, of course, in paying off our debts, but he knew our concern. We had talked with him about our concern about regarding our future and how we felt like our debt was essentially wiping out our future. If you think about it, when you're in your 20s, like we were at the time, and you're throwing all this money at your student loans, it feels good until you realize that those are the most valuable dollars you'll have in your entire life.
Oh, yeah. The power of time.
You got it. Yeah. Compound interest, Courtney. Yeah. So he sat us down and he unpacked a concept to me that revolutionized my life. It was like the red pill moment from the Matrix. It was the aha moment that I think changed my family tree.
Well, tell me, Keanu Reeves, what was it?
That's right.
Seriously.
So it brought up some of the key things that had troubled me about paying off our debts, and about the debt snowball method. So let me quickly describe the debt snowball method so you know what we were doing, and then I'll talk about something we have now coined, the debt snowbank method. Oh. So it'll bring us hopefully to our conversation today. So most people who are in debt have at least heard about something called the debt snowball method. And just very quickly, it's where you list all of your debts from smallest to largest. You make your minimum payments on all of your debts except the smallest one. Okay. And then, or possibly the highest interest, if that's your thing. but you throw all that you can toward that one account. Everything above your minimums go toward that one account until it's paid off. And then you take what you've freed up there and apply that to the next account. And you keep doing this all along the way. And most financial gurus will tell you to keep only $1,000 in your savings account while you do this. So my question to that is, what could possibly go wrong in the midst of
nothing.
that?
You won't have any emotional reaction to the way that you spend your money and things that come up, right? Because we don't, interact with our money emotionally 90% of the time, right? So nothing could go wrong, Mark.
Right?
Nothing.
Yeah. Well, and with a solid $1,000 in my savings account, if I have even the smallest emergency, I'm going to do what? I'm going to have to fall back down the debt staircase, take out a credit card to fix the flat tire. I mean, what? So that was kind of my experience. I was trying to pay off this debt, but I was getting older and I was falling back down the staircase only to have to climb out again and again, because everyone's got the health emergency. Everyone's got the job loss. Everyone's got, life is throwing you curveballs. So, what if there was something that brought us something better than just being debt free? What if there was a way where you could become your own source of financing and actually snowbank your debt instead? And that's sort of what we've discovered as a strategy for our clients. For myself, it helped my wife and I pay off our student loans. Here's how it works. Instead of putting money toward all of our debts, giving our banks our best dollars, we put as much as we can into our own bank instead. And here's kind of how it works. Step one, you keep current on all your debts. We want to set up auto drafts so that certainly all of your debts are paid. We want to make sure everybody's, at least satisfied, keep those hungry hordes at bay.
Yes.
Step two, we're going to start funding a dividend paying whole life insurance policy of all things. Why in the heck is life insurance a part of this process? Well, it is the only financial vehicle that I am familiar with, Courtney, out of 450 products I had to research to become a CFP. It's the only one that most closely mimics the banking function. And so I'm going to take a side note here to just quickly describe this, and then I'll get back to Snowbank here. So whole life insurance is a 200 plus year old financial vehicle. It's been around for 200 plus years. And it functions like a wealth reserve. You can build up not just a death benefit, which is great for the kids and whatever, but you can have a cash value that you can use and enjoy on this side of the grass before we pass away. And that cash value is sort of like a bank. You can treat it like a line of credit to yourself. In fact, you can borrow against this cash value like a bank, but unlike a bank, you, instead of the banker, are in control of repaying this loan to yourself at whatever pace you wish. You could, make large payments every month. You could pay small amounts. You could change it up. You could stop for 6 months if you lost your job. There's no required repayment plan. And so while we're in control of now repaying loans to our policy, now we're the one that has the levers. We've got the levers that we can pull rather than the bank telling you must pay $800 a month or $1,200 a month or whatever your payment is. Does that concept make sense so far?
Oh yeah, absolutely. And I actually just this last week finalized increasing my whole life insurance policy to up over $1 million, because I do know that this is such a great concept, and it's a great tactic to be able to build your wealth, especially for later in life after. And you're not trapped into the specific retirement age, which there is a time and a place and a function for retirement vehicles like 401k, for example. But for individuals wanting to retire early, you've got to think about how will you build that source of income for yourself prior to being able to tap into your 401k, for example, or your Social Security. And so it's another great mechanism and function to add into the tool belt, because you're creating essentially a line of, and also generational wealth. That's the other aspect that I love of this is, you've got that cash reserve, but then also you do have the death benefit within the same mechanism.
So true. That's right. So imagine for a moment, we've got all of our debt on one side of the ledger here, big pile of cash of car loans, student loans. For my wife and I, it was a bunch of student debt. And now imagine a second pile, much smaller at the start, which was our bank, our bank on yourself designed whole life insurance. And that slowly starts at the beginning, but it quickly begins to build up significant wealth. And as time and months and years went on, we were able to borrow against our life insurance and wipe out one student loan at a time. And that was wonderful because it freed up all that cash flow going to Sally Mae and all of her cronies.
Yeah.
But some people would say, well, Mark, why didn't you just pay off the debt? What good did that do? And the real clincher here for me is when I realized that when I borrow against one of these policies, there's a specific form of whole life insurance, and it's called a non-direct loan, non-direct recognition loan. And what this means is, and this is so huge, when I borrow against my life insurance cash value that was designed this way, the bank on yourself way, the policy itself, Courtney, will continue to compound and grow as if I had not taken a loan. So if I've got $100,000 of cash value, let's say, and let's say I borrowed $30,000 to wipe out a loan or pay off a car, my policy will still pay me a full dividend, guaranteed growth and dividends on top of that on the entire $100,000, as if I hadn't touched a dime of the money.
Yeah.
To me, this beats paying cash for paying off my debts or heck, even buying stuff, whether it's real estate or cars or whatever else.
Well, and you're still able to capitalize on that eighth wonder of the world, which is compounding interest. And what's the most important commodity when it comes to investing for your future? It's time, right?
Time.
I mean,
yeah.
So you aren't, hurting yourself in regards to time, right? By saying, okay, well, as soon as this is paid off. So I definitely can see the draw to this strategy. How would someone know that this is right for them? That's another question because, again, your whole financial picture has to be taken into an account. So is there some questions they could maybe ask themselves to say, is this something that I should do?
Yeah, that's a great question, Courtney. And certainly I wouldn't recommend anyone just rush out and start opening up whole life policies just because they heard it on a podcast. Even one as wonderful as yours, Courtney. You still want to sit down and talk to a professional, someone who absolutely knows your concerns, your cash flow, your goals. I've seen too many people, unfortunately, think that they have something like this and it was not designed properly. A lot of folks who ended up in, say, an indexed universal life policy, and those are fine too, but they're not designing it for banking purposes. And I've even met people who thought that they had a bank on yourself designed policy and it was a variable policy tied to the stock market, which again, nothing wrong with that, but it doesn't offer that non-direct loan, which lets the policy do compound growth even when you borrow against it.
Yeah.
Some considerations. It does take some extra time. It took me and my wife an extra 9 months to pay off all of our debt. So we were comfortable with that longer period because it allowed us to have an extra $250,000 in retirement just because of that uninterrupted compounding that came with us using the policy rather than paying the debts off the old-fashioned way. So that means we do have to have long-term thinking, not short-term thinking. And a lot of people who are in debt, really, they're laser focused, and I respect that. My hope is that folks would think long range and think even, and by long range, I mean like 100 years, because, we are going to have a nice financial life, right? But what about your beneficiaries? What about your favorite charity? What about your kids? Right. And to set this up now could change their entire trajectory of their life.
That's a great point.
Those are some considerations.
Yeah, absolutely. Well, and with the debt snowbank, so first step, keeping current on all your debts, keep them at bay.
Yep.
Number 2, you're going to fund the dividend whole life insurance policy. And what's the next step in that?
Step 3 is to use your policy to pay off your debts. So as your cash value increases and your debts are slowly decreasing, there's going to come a day where the cash value is equal to one of your loan balances. And you simply request a loan from the life insurance company. The money is automatically deposited into your bank account within about a week or so. And you simply use that cash then to wipe out the student loan or the car loan or whatever, even a house mortgage. Step 4, the policy continues to grow as if you never took out the loan. There's that uninterrupted compounding. And the last step is to pay yourself back on your own schedule and then celebrate.
So tell me a little bit more about the paying yourself back on your own schedule. How does that mechanism work where you're in control of that?
Yeah, quite literally. I just took a loan from one of my policies recently for an investment I wanted to make. And so that's a whole nother conversation. You don't just have to use this for paying off debts and paying off the past. You can also use it to accelerate your returns in the present and the future. But anyway, you borrow from your policy, and like I said, with no questions asked, they're going to dump that money into your bank account. There's no credit check. They don't ask you what you need the money for. They simply ask you, how much cash do you want and what bank account do you want us to send it to? That's basically it.
That's a nice short list. Yeah.
Nice loan underwriting there.
Yeah, exactly.
And then as far as repaying the loan, they say, hey, here's a form. If you want to repay this loan, here it is. If you don't pay off the loan, it is a non-recourse, fully collateralized loan. So what does that mean in plain English? It just means they already have what they need. If you never pay off that loan, they'll simply deduct it from your death benefit. So you mentioned your $1 million death benefit, I assume.
Yes.
So in that case, let's say you borrowed, and I don't know your cash value, but let's say you had $100,000 and you wanted to borrow $100,000 out of your cash value. And that would mean your death benefit, your net death benefit that afternoon would be $100,000. So I'll use me because it won't end well here in this story. Let's say I had those numbers and I died yesterday. My family would get not $1 million, but they'd get $900,000 because there was a loan outstanding. Now, what about that extra $100,000? Well, if it went into real estate, right, they would also get to keep the house that we'd bought or apartment building.
Yeah, depending on what you used the loan for. So that's another part of this strategy. Mm-hmm. So what are the top reasons people do a non-direct loan option out of this whole life policy? You mentioned paying off debt, but you also mentioned like real estate. So can you tap into that a little bit more?
Yeah. Well, the key question is, what can you not use this for?
Yeah, exactly. Because they don't ask, right?
Yeah,
like you said.
Yeah. I mean, I just interviewed a client yesterday for our podcast, Not Your Average Financial Podcast. And he talked about how he's used it for the birth of his child. He talked about how he used a policy loan for some medical expenses for the birth of their child. He talked about an unemployment season where he borrowed from his policy to cover some unemployment he needed. He talked about how he's used it to invest in Bitcoin and made a killing on that and had some additional arbitrage there. He's used his policy to invest in a condo rental unit. So the list goes on, but ultimately his policies will be a tax-free stream of income in his retirement years. So he views it more like a Roth IRA, but without some of the red tape and income phase outs that a lot of people are heartburned by with Roth IRAs. In other words, there is no income phase out and there's no contribution limits to these policies by the government. And it's a tax, if it's designed correctly, the tax law says we can get the principal and the gains out of these policies in retirement or even before retirement, totally tax-free.
You know what? You just said a hot word that I wanted to jump on there. You said tax-free income. So I wanted you to expand a little bit on the tax advantages that maybe come along with this strategy, because that's another portion, I think, when it comes to financial planning that a lot of people don't automatically take into account is how much money are you saving on taxes, So can you expand on that just a little?
Do you want the 30-second or the 3 minutes or somewhere in between?
I think as whatever feels right to you is what you should do. Yeah.
Well, there's so much going on right now in the world of taxes. Yeah. And there was a perfectly timed, and I say that sort of ironically, perfectly timed data dump from the Treasury Department. It was a data leak that showed the 25 wealthiest Americans, their tax returns for the last 15 years. It included Jeff Bezos, Carl Icahn, Mike Bloomberg, the list goes on, Mark Zuckerberg, and all of them follow the same formula, which is a strange phrase, but I'm going to say it. It's buy, borrow, and die. That's BUI, borrow, and DIE, die. And that's essentially what they're doing. They essentially buy stock, company stock, whether it's Tesla or Amazon, and their highly appreciated stock is then borrowed against, which has no taxes due, right? Income is taxable, yes, whether you're Warren Buffett or you and me.
Yep.
But loans are not considered income by the IRS, and those therefore are not taxable.
Yes.
And then if you pass away, those loans can be netted out by a step up in basis on all of your highly appreciated assets, whether it's real estate or stock or whatever. That's the buy, borrow, die strategy. And you can look that up. It's kind of a rabbit hole to go down. But, I'm not Jeff Bezos. I don't know your net worth or anything, Courtney. Maybe you are right among them. Maybe you were in that tax league as well.
I'm planning on going to the moon, baby.
Come on,
I'm right up there with Elon Musk. Yeah.
Love it. Well, I'd love to go with you. That'd be awesome. But we can do this same strategy of buy, borrow, die with more modest means. You can use a dividend-paying whole life insurance policy to do the exact same thing Bezos, Musk, Buffett, and the rest of them are all doing. You purchase life insurance through premium. That's how you buy, BUY. And you can borrow against a cash value that is not taxable. The IRS tax code for over 100 years, as long as we've had an income tax in this country, does not count policy loans as income. And so that's a tax-free access to cash. You could have millions of dollars in your policy and borrow against that and live very comfortably. And it doesn't count toward your income tax. It doesn't count toward capital gains tax. It doesn't count toward gift tax. It doesn't count towards the estate tax. If you're borrowing against it and you're still alive, there's no taxes due there. And then when you pass away, the death benefit is income tax free to your heirs. So I can't find a more efficient way to live the billionaire lifestyle, even on a few less zeros, even if you don't have quite as many zeros in your net worth.
Exactly. Well, and you know what I wanted to reiterate too is that we're all taxed, right? Whether you're Jeff Bezos or you're just an average middle class worker. But something that's so fascinating is that W-2 employees are the highest taxed working part of our country. And so you think about being W-2, having this income that's taxed at a much higher rate, and then you go to capital gains tax, right? And that's where you've got your investment portfolio. But then you go to something like a loan against your whole life insurance policy where it's not taxed because it's not considered income, it's considered debt. And when you think about your balance sheet, you've got your asset column and you got your liability column, and it's in your liability column technically, which is a great tax strategy, as you've said, and you're a certified financial planner.
That's right. Well, and I'll even throw in there as a bonus, it doesn't count toward your provisional income either. So that helps you keep more of your Social Security tax free, and Medicare premiums aren't higher too. A lot of folks don't realize that 401ks, IRAs, and more are a ticking tax time bomb. This is a surprise to a lot of folks that a third of their 401k belongs to their uncle.
Yep.
If you know what I mean.
Yep. And his name's Sam. His name's Sam,
right.
guys.
Sam. Well, and this blew me away too. We all have fees on our 401ks and IRAs, right? There's no free lunch. There's no charitable 401k that I'm aware of.
Right.
So how much of the balance of your 401k are you charged a fee? Some of it or all of it? All of it, right?
That's the answer.
How much of the government money how much does the government chip in to help you out with that fee?
Oh no, you got to pick up the bill.
You got to pick up that bill. That's right. Yeah.
They're not paying on this date. Come on now.
It blows me away. And how much does any of us know, if we're not already in retirement, do we even know how much of our 401k is ours?
Yeah. No. Like, do you know the dollar amount?
Yeah.
And I think a lot of people are blissfully unaware that, they and if they don't go sit down with someone who is a planner, right, and can actually take into account the amount of taxes that they're going to pay. And I would say a large majority of people contribute pre-tax dollars to their 401k. So, it's like you're going to be paying a lot in taxes once you start withdrawing from it. And it's a hard pill to swallow.
That's right. Well, and even if we don't think taxes are going to go up, and most of the clients I work with over phone and Zoom, they do sort of readily admit that taxes are going to go up. But honestly, we all lead such busy lives, Courtney. I don't fault us for not putting two and two together, but we all understand that, yes, okay, 401k will be taxed in the future. And yes, I think taxes are going to go up. Almost every client I talk to says those things.
Yeah.
But we honestly, we don't necessarily put those two thoughts together. And when we act against our beliefs, I believe it causes us internal stress, even if it's subconscious. If I act against my belief, I might want a 6-pack, but I also love ice cream, and it's not until I put those two things together that I realize that I can't have tax deferred 401k and have a tax-free, blissful retirement.
Yeah.
And so I'm with you all the way on that. Taxes are going to be more and more an important part of our planning. And through our firm, we try to do a annual and lifetime tax assessment to see if we're on track or if we're going to be, leaving the IRS a tip.
Yeah. Well, and the tax portion that we were just discussing, it's like it's an uncontrollable element to this plan, because the government at any time can say, you know what, actually, to pay back our infrastructure bill or, whatever, our stimulus, we are going to increase to X percentage on, retirement accounts. I mean, that is something that they could do at any point in time. So you really can't control that aspect of it. So being able to take more control, diversify outside of, don't have all your eggs in one basket. Don't only contribute to one type of strategy or investment vehicle, because you need to be able to mitigate for those risks that could be associated with that particular, vehicle that you're investing in. So if the listeners could only take away one, like they have instant amnesia, right? I love to say this is like, as soon as you stop listening, you're like, what did I even listen to right now? It was great. I just don't know. What do you want them to remember and take away from this?
You can fire your banker. You can take back control of your future and bank on yourself.
I love that. I love it so much. And so I'm going to be tagging your podcast, Not Your Average Financial Podcast, in the show notes. Where else can the listeners find you so I can make sure to include the links?
Yeah, if you want, the one link besides the podcast, thank you for that. If folks want to connect, have a quick phone call with me, talk about this strategy, I'd say go to bit.ly/boyfuture. That's bit.ly/bank on yourself future. So bit.ly/BOY future. Go there and say hello, and I'd love to answer questions.
Yeah. And guys, I'll make sure to just link it so you can just click on it if you're driving or, doing what you do when you're listening to your podcast. So that way it's really easy for you to access. But Mark, thank you so much for coming on. It was so fun and I love having discussions with other podcasters as well, because it's like, we're such money nerds to the point of where we do it for fun. It's like, I just own it now instead of being embarrassed. It's like, I'm a fellow money nerd. So thank you so much for your time. I really appreciate it. And I look forward to chatting with you again.
Keep up the great work. I love what you're doing. Keep living the dream.
Thank you. I will keep living the dream. And guys, you know where to find me online. It's at Financially Free Journey. That's on Instagram, TikTok, financiallyfreejourney.com. I post daily tips and motivation to help you on your journey to financial freedom. Until next time.